Gold's giant rally. Gold prices near a 7-year high. Palladium madness continues. Precious metals shine bright. EVs on the brink of change. Tesla dominates the EV market. How traditional car companies and nimble startups can compete. And Permian player. I sit down with Matt Gallagher, CEO of Parsley Energy, to see if a higher dividend and solid production is enough to woo investors. I'm Alix. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest voices with the smartest voices in the business. First, we kick it off with Spot On. It's our spotlight today is on independent U.S. oil and gas players. They kicked off earnings this week, and the group has been punished by investors who want capital discipline and better returns, not constant aggressive spending. Now, some names actually listen. You got Concho, Devon, Pioneer, Parsley, and Diamondback all raising their dividends in the last earnings report. Joining me now is the man that dubbed this week Permian Week, Paul Sankey, Mizuho Securities Senior Oil and Gas Analyst. Paul, good to see you.
Hi, Alex.
So, who did it right? Who won?
All of them. I mean, we love the fact that they're all doing it together. So, that's absolutely key because we love to see them competing now for cash return. And we're talking about a virtuous circle here, So when the entire industry gets into this dividend competition, they're also taking money off the table that would otherwise probably be spent on CapEx. So they can then get the commodity into a virtuous circle as well.
What's the issue, though, when you are unable then to spend the money to, say, stem decline rates or offset the decline rates? Does that become then a why is your production growth falling issue, or are we not there?
No, we're not, because they're still all growing at double digits. Mm-hmm. Our argument was that they don't need to grow at 15% plus. That's way beyond what the oil market is growing. It's way beyond what's needed by the market, essentially. So they're able to cut back and still grow. But you make an excellent point, which is that unlike refining, where we had a similar, if you want, attack on the industry in terms of overspending and lack of cash return, the refineries just sit there, so you don't need to spend to grow or stand still. You can actually just more or less harvest cash. And that's a really nutty problem that you've referenced, is how do you balance cash return with maintaining your volumes and growing your volumes as an E&P.
Growing, maintaining your volumes to then get the cash flow to then fund your dividend, so you don't have to borrow and then keep your debt low.
Exactly.
So it's a very tricky balance for these guys.
It is.
When you take a look at the coverage world that you have, who is doing it totally right, who still needs to improve, who's doing it wrong?
Pioneer, we think, sort of leads today's, and if you like, this week. We've called it Permian Week, and they've done very well. They had great call today with Scott Sheffield, also talking about ESG, and all of them, in fact, are doing the right thing in terms of their ESG messaging, more or less. But generally speaking, the focus of the Permian plays, Parsley, Concho, Diamondback, are all getting it right in our view now, and are really well located in terms of their assets and what they can do. Our argument always was that these companies have the best industrial opportunity that they've had for the past 50 years. The problem's been their strategy. So we're thrilled to see the strategy is coming right. And this is not just a special, we're looking for a sustained performance here, obviously, because as you know, the dividend yields in absolute terms are still pretty small.
Who's not doing it?
Exxon. Actually, it's crazy to think that when you look back over the cycle, how we could get to a place where we're lauding the US E&Ps for growing their dividends and showing capital restraint, and then be completely an opposite world to have Exxon as being
not doing either,
quite consciously outspending. Now, of course, we've got the Exxon analyst meeting coming up March 6th, so we'll see if they change, March 5th, I should say. We'll see if they begin to back off that strategy, but it's not really their style to commit in the way that they have and then change direction.
100% true. So when you look at the underperformance, and we just have sort of the US E&Ps versus the oil price, to just focus on that. If you look at that underperformance, when does that start to turn around? Is this actually enough to draw in investors who have been so burned by this space?
I was speaking to one of our senior salesmen, David Miller, on the West Coast, and he was saying that he decided to go with our message yesterday to investors on the West Coast and to talk about our Napa conference in late March, and he got no responses whatsoever. So his, there's two ways of looking at that. For a Wall Street guy with his experience, he sees that as a very powerful sign. That is to say, we're clearly bottoming, and the fact that people aren't chasing these stocks in any way, shape, or form makes this a great opportunity, I think, to start looking at a long-term investment.
Do you also need to distinguish which players have heavier oil versus gas, considering that flaring has been such a contentious issue, as well as takeaway capacity, and as well as having to take write-downs on your gas assets? assets, particularly in Appalachia. Like, how do you see that?
Yeah, all the above plus the price. I mean, you had Cimarex talking about an assumption of 5-cent Waha gas prices. That's 5 cents per MMBTU. You multiply by 6 per BOE. So you're talking about 30 cents a barrel of oil equivalent. I mean, in crazy numbers. So there's the price and all the issues that you said. And yeah, absolutely. All of the guys that we're talking about that would be the Pioneer, the Fang, the Diamondback, the Concho, all those guys have a very high oil cut, relatively speaking, led by Pioneer.
All right, really great stuff. Paul Sankey of Mizuho Securities. Love your notes. A little snarky. It works. All right. And the coronavirus isn't the only outbreak affecting the commodity world. Take a look at this. It is the worst locust infestation that parts of Africa have seen in 70 years, and it's now spreading to South Sudan. The outbreak threatens crops in a country where about half of the population is already facing hunger. Officials say the number of insects could grow by 500 times by June when drier weather actually begins. This is Commodities Edge on Bloomberg. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for the data dig. We delve deep into the market trends. And first up are the U.S. oil inventory numbers. So stocks overall rose by 415,000 barrels, much less than expected. And the surprise was the draw in Cushing in Pad 2. A big part of that were actually strong U.S. exports. And turning to one commodity that's really moving is gold as a safe haven. So according to Citi, the gold options market on a skew basis here is that white line. Looks very much like we did in 2010, 2011, but that's when gold prices were actually $1,800 to $1,900 an ounce. Now they're looking at net long positioning, that blue line. Yes, it looks extended by this chart, but Citi says if you normalize it, positioning for the expanded asset base, Citi says it's only half the levels of what we saw in 2011. Net-net, the rally could have more room to run. And wrapping it up with the farmers here, American farmers have complained about the U.S.-China trade war draining their incomes, but they might now get some relief. This shows that profits are actually expected to rise 3.3%, and the USDA said Thursday that U.S. corn planting will likely rise to 94 million acres. That would be the highest in about 4 years. All right, now we get into the ring. It's electric vehicles versus traditional autos. EVs have changed a lot since their inception in the 19th century, even though they still face the same challenges today.
As early as the 19th century, many cars on the road were already electric and appearing in newspaper ads like this one in Pittsburgh. But in 1908, Henry Ford introduces the gas-powered Model T, and until 1927, Ford would perfect the assembly line and build some 15 million Model T cars. It won't be until the mid-60s when we start seeing electric cars come back, mostly concept models like the Henny Kilowatt. In the late 90s, the world gets its glimpse of hybrids, among them the Toyota Prius, which rolls into America dealerships in 2000. 3 years later, Tesla forms, and in 2008, the company debuts the Roadster sports car. It's followed by the Model S, Model X, Model 3, and more. At the same time, Asia proves to be a dominant player. The Nissan Leaf becomes the world's best-selling EV in 2010, and China becomes the world's biggest EV market ever. Its billionaire investors include Jack Ma and Warren Buffett.
For a look at how other automakers are trying to keep up with Tesla, joining me is Peter Rawlinson, former Tesla engineer and now CEO of Lucid, a potential Tesla competitor, and he joins us now from San Francisco. Great to talk to you, Peter. I'm excited about the interview. Tesla still dominates the market. How long does that last?
Well, Tesla dominates because they are the technological leader. And what's not recognized is this is a tech play. Their technology has been recognized, and I think that's been a major factor in the recent surge in their share price.
So is Lucid then a tech company and then / competitor to Tesla, or is Lucid going to want to be a car company like a Ford or GM?
Well, I guess all of those things. First of all, cut us to the core that we're a tech company. This is a technology play, and that is not sufficiently recognized. But there's room for Lucid to thrive alongside Tesla. We have a world of luxury products, which is dominated by the German automakers, Mercedes-Benz, Audi, and BMW, and they're gasoline products. Lucid is a luxury EV company, and we're going to compete with those core competitors, which are the German companies. Mercedes S-Class is our core competitor car. There's plenty of room for Lucid to thrive and coexist alongside Tesla.
Part of the issue with this whole transition has been money. Automakers are pouring money into this. I mean, billions. It's not yet profitable for them, even though battery prices are coming down. Are you going to need more money to make all of this happen?
Well, we've got great funding in place. We're in a healthy financial situation through to start of production. We will need to raise more to accelerate the growth of the company because we have a wonderful window of opportunity now in the next few years. We want to accelerate our growth. We'll need more capital to do that. And we want to accelerate the growth of sustainable mobility to the world. And right now, that's what mankind needs, a widespread adoption of renewable, sustainable mobility through renewable sources.
Can you put some numbers onto it, sort of how much more you think you're going to need to raise and how quickly then you can grow?
Well, I don't want to be too specific here because it's early days, but the world knows that although we're a tech company, the auto business is intensely capital intensive. So we're talking nine-figure sums.
Nine-figure sums, do you feel like the market's open to that? Because they seem to punish traditional OEMs when they have to sort of fire people and then cut their buybacks or something, and they seem to reward it to Tesla. What's the response?
I think that the traditional OEs are really struggling because they have their processes, they have their methodologies, and many of those are ill suited to this rapid transition now to electric mobility. We're a startup with a startup mentality. Lucid Motors is based here in Silicon Valley, at the heart of Silicon Valley, and we're very entrepreneurial with our spending, and our whole business philosophy is run that way.
What is different about a Lucid car or battery or execution from, say, a Tesla or other EVs out there?
Well, what differentiates us is world-class technology. Our battery technology, we supply the batteries to all the cars in Formula E. Mm-hmm. So we have this race-proven battery technology underpinning our car. But our motor and inverter and the software, even our transmission, is truly world-class. We have a technological lead. Lucid already has cars out there in test, which is surpassing 400 miles of range. And that's not in artificial conditions, that's in real-world test conditions. We already have the very first 400-mile electric car. And, words are cheap, so please don't take my word for it. What we're going to do is invite journalists to participate and observe such test runs in the very near future so they can report out that the era of the 400-mile range electric car is already here, and the technological lead is in Lucid's hands.
So quickly, when can that happen, and then when are you going to need the money?
We're going to demonstrate that we have this great technology over the next few weeks in our run-up to a world premiere at the New York Auto Show in early April. The financial situation, really, the requirements for more money are to accelerate the growth of the company with bringing in an SUV based upon our Lucid Air platform as soon as possible. And I just can't wait to do that.
Peter, it was so great to catch up with you. I really appreciate this interview. Peter Rawlinson, Lucid Motors CEO.
Thank you so much.
And a programming note, you must tune into my Bloomberg special, EVs on the Brink of Change, airing all of this weekend. A time now for Note of the Week, and it comes to us from Dallas Fed President Robert Kaplan. In the latest regional assessment of economic conditions, the Fed writes U.S. crude oil production growth of approximately 400,000 barrels of oil in 2020. This compares with production growth of 2 million barrels of oil a day in 2018 and 900,000 barrels of oil a day last year. Capital spending in U.S. oil and gas sector could decline by as much as 10% to 15% this year. All right, coming up, we're going to hear from one of the Permian players, Matt Gallagher, Parsley Energy CEO. This is Commodities Edge on Bloomberg. I'm Alix Steele. This is Bloomberg Commodities Edge. It's time now for BNEF Brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. The Federal Energy Regulatory Commission recently directed PJM, largest power market in the world, to introduce bid floors for state-subsidized power plants. Joining me now is Nicholas Steckler from Bloomberg NEF. It sounds heady. It's actually quite significant. What does it actually mean?
Well, the regulator is trying to insulate the U.S. electricity markets from subsidies. And specifically, these are subsidies that the states give out to zero-carbon power plants, like renewables and nuclear power. What they believe is that these types of subsidies are undermining the competitiveness of the power market and potentially allowing power plants to submit artificially low bids.
Mm-hmm. So if they provide this floor, what does that do?
So they put in these floors on these technologies that do receive subsidies, and that's going to drive up prices. So we've done some modeling on the PJM market where they have put in the floors. We think it's going to drive prices about 30 to 90%, depending on the zone. And actually, we just got news this morning that there was another ruling from FERC about 2 hours ago that they're going to do something very similar in New York.
So if you take a look at the pricing, like who's going to feel the biggest pinch? Where regionally are we going to see it?
Broadly, there's a lot of benefit for coal and gas-fired power plants. We think new renewables and specifically nuclear power plants are going to be hurt because they're going to lose those capacity revenues. And consumers, anybody that has to buy a lot of electricity is going to see higher prices.
So, and this shows that the ComEd. So what region is that? That seems to be where the remodeling shows the highest price.
That's the Illinois region. EMAC is the eastern region. And the rest of the RTO, the rest of the power market in the Mid-Atlantic will also see higher prices as well.
Okay, quite significant. All right, thank you very much, Nick Steckler of Bloomberg NEF. We turn now to Commodity in Chief, where we focus on one executive in the commodity world. And today it's Matt Gallagher, CEO of Parsley Energy. First, a closer look at his company.
U.S. oil exploration and production companies are unloved, shunned, and some are even hated. They underperformed the oil price in S&P last year. Why? Well, Wall Street poured more than $200 billion into the oil shale patch over the past few years, and most drillers can't even produce healthy returns. CEOs desperately want to change that. Here's how they can do it. Grow production on the cheap, which gets hard as current wells' rate of growth slows. Increase buybacks and dividends. Stay CapEx disciplined, don't increase production when oil prices go up, and be cash flow positive. Enter Parsley Energy. It just bought Jagged Peak for $1.8 billion, which helped it increase its presence in the Delaware Basin in the prolific Permian. The combined company now has 266,000 net acres, which allows it to drill longer laterals and will have more bargaining power with oil services providers to cut costs. There was $141 billion worth of M&A in the U.S. E&P space last year, and now it's up to them to prove to shareholders they were the right deals.
Well, Parsley recently reported earnings, and it sees free cash flow this year at $200 million at $50 oil. So I recently caught up with Matt Gallagher, the CEO, and talked about the company's oil production outlook.
You're starting to see a playbook evolve of what can actually be digested. It needs to be accretive on all cash flow and financial metrics. It needs to be in the same zip code, same neighborhood is even better, and it needs to enhance scale. If you do all those things and you can amplify your cash flow profile, it's being received relatively well. But the industry has had some step outs on the acquisitions front, on the M&A front that weren't received as well. So I think the playbook's evolving, and I think the last two deals have been received much better.
Where does the execution risk lie then? If you have to deliver such specifics for investors, where's the problem?
You can't overpromise. So that's the other part of these deals. So you have to have tangible synergies that you can deliver on, and you need quick wins, and then you need to deliver execution over the subsequent 4 quarters is usually the judgment time frame if these deals are working.
And what's the free cash flow leverage, the boost that you're going to get from this? Can you do it like a shorter term, longer term thing for me?
Yeah, so in the short term, we're going to be well north of $200 million a year of free cash flow on a standalone basis, and then this could accrete to that on the order of $30 million to $50 million just on the front year.
I feel like a year ago, the natural conversation would have been like, so like when's Chevron going to buy you? Like when Exxon's going to buy you? Is that still the conversation?
During 2019, they made some promises after the Oxy-Anadarko deal. They said no high premium deals. So that has gone a little bit on the back burner from their narrative. But I would anticipate M&A to pick up in 2020.
Do you think it's going to be the majors, or do you think it's going to be tie-ups like you did with Jagged Peak?
I think there's a lot of work to be done on the smaller operators running 5 rigs or less. So I think that's where the majority of the operations will occur, or the mergers will occur. But I think no doubt that over the next 2-3 years, the majors need to make a move.
There is a discrepancy in the industry of how much shale can actually grow. I know you're going to be biased on it, but what do you think for 2020? I'm
actually probably biased in the way that you wouldn't expect. I think that shale is not going to meet its growth forecast. It's very difficult. When we look at the same counties, we call it same store sales, the well productivity is actually already declining. Other basins, the Bakken, South Texas, they're already on a productivity decline. I think the EIA, the IEA are forecasting productivity increases for the Permian. If you flip that, it's going to be very difficult to meet the forecast over the coming years. So we have to keep the focus on cost, and we have to imprint new technologies to extract more productivity out of these wells.
Why are we losing productivity? What's happening?
Well, you look at these reservoir systems, they're 2 miles under the ground, and it's essentially one large tank. So you have a pressure drawdown over years, and we use a 2 to 3% aging factor on our wells when we do our modeling. So it's just over a long period of time, as you extract resource, the pressure draws down, and it's harder to recover that resource in the long term. It
feels like the story now for 2020 is all the offshore stuff that's happening, whether in the Gulf of Mexico or more importantly Brazil or Guyana. It feels like the narrative's changing to that's where we're going to see more of their production growth. What do you think? There's a big slug of production growth coming offshore worldwide, and it is Guyana, it's Norway, and these were projects sanctioned in the early part of the decade, 2010 to 2012. They're finally coming online. However, you rewind back to 2014 to 16, and that exploration capital just completely dried up. So again, you come into a time frame 21 to 2025, and we don't see a lot of these projects coming online. So there is going to be a big call on the U.S. shales to deliver, and we hope to do our part.
That was my interview with Parsley CEO Matt Gallagher. Now on to something that you can try and trade just for the halibut. The London Fish Exchange officially opened up with farmed Atlantic salmon kicking things off. The LFEX enables farmers, producers, exporters, traders, and buyers to connect, market, and distribute their products in a controlled environment. There's a lots to love about this. All right, here's what's on my commodity radar. Monday, IP Week kicks off in London, but it's going to be a little bit tighter there because of the coronavirus. Wednesday, you get Apache earnings. Key what they're going to say about the Powder River Basin. Also Thursday, Occidental earnings still have to prove that the Anadarko deal was good. No doubt to look at those wells and how efficient they're able to make them. And a reminder again to tune in this weekend for my special program, EVs on the Brink of Change. That wraps it up here for me at Bloomberg Commodities Edge. Catch me each Thursday at 1 p.m. New York time, 6 p.m. in London. And this is Bloomberg.